Welcome, everyone. So in our previous discussions, we've really laid the groundwork, right? We've covered the fundamentals of how you record transactions. Today, we're going to build on that foundation. We're moving beyond just the what of bookkeeping and into the why of financial architecture. We are going to dissect the very blueprint that every successful company uses for its financial reporting and, maybe more importantly, for its strategic decision-making.
So let's just start with a really basic question. Think about it for a second. How does any organization, from a massive global corporation handling millions of transactions a day, all the way down to your local coffee shop, how do they keep track of everything? Every dollar coming in, every salary going out, every single cup of coffee they sell, how do they do all that without it just turning into complete and utter chaos? Well, this is the central problem that accounting solves, and the solution is actually pretty elegant.
Because without a system, this is exactly what a business's finances look like. It's just a random list of stuff happening. Coffee beans, rent, a bank loan. It's a chaotic, unusable jumble of raw data. And from this, you can't make a strategic decision. You can't file your taxes. You can't report to investors. You have no idea if you're actually profitable. It's just noise. It's not information. So the main job of any good accounting system is to bring order to this chaos.
So here's our roadmap for today's lecture. First, we're going to really define this problem of financial chaos. Then we'll introduce the key tool that brings the order, the chart of accounts. After that, we'll do a deep dive into its anatomy, see how this whole framework actually helps you make business decisions, and finally, and this is really important, we'll talk about the common mistakes to avoid. Getting this right is absolutely crucial for your future careers.
All right, let's jump into our first topic. The fundamental challenge for any business, and for you as future managers and leaders, is figuring out how to turn that raw, chaotic noise of daily business into information you can actually use. This isn't just about following rules. It's the entire reason we have accounting systems in the first place.
And that brings us to the solution. We call it the chart of accounts, or you'll often hear it called the COA. Now, I really want you to resist the urge to just think of this as a simple list of categories. It is so much more than that. I want you to think of it as the master architectural plan, the central nervous system, the very skeleton that a company's entire financial house is built on.
Now let's look at the formal definition from our text. It's a systematic listing. Now pay very close attention to that word, systematic. It's not random. It implies logic, order, and a very deliberate structure. This isn't just a bunch of labels thrown together. It's the foundation, because every single transaction, every sale, every purchase, every loan payment has to be sorted into one of these specific accounts. This systematic approach is what gives us consistency, and that's what allows for meaningful analysis over time. Without this solid foundation, everything else just falls apart.
You can almost think of the chart of accounts like the Dewey Decimal System for a library, but for a business's money. It has four main jobs. First, it organizes everything into logical buckets. Second, it standardizes how we report things. A utility bill always goes to the same account, so you can actually compare your electricity costs this June to last June. Third, these accounts are the literal building blocks for your main financial statements, like the balance sheet and the income statement. And fourth, and this is the most critical part for this course, it enables clear, data-driven decisions.
Okay, let's move on and see how this thing is actually put together. We're going to take a guided tour of this blueprint's anatomy. We'll look at the different sections and really try to understand the logic behind the structure. And what you're going to see is that this isn't arbitrary at all. It directly mirrors the fundamental accounting equation. Assets equals liabilities plus equity.
This table does a fantastic job of illustrating the basic structure. Notice the numbering system. It's a hierarchy, right? The 1000 series accounts, those are all assets. The 2000s are all liabilities, and so on. This logical grouping is a pretty universal standard in accounting. It's what lets software automatically generate financial statements, it helps auditors do their job, and it allows managers like you to quickly find the specific information you need. So, let's walk through each of these 5 main categories.
Let's start with the 1000 series, assets. These are the economic resources that the company owns and controls. We're talking about things like cash in the bank, inventory on the shelves, maybe a delivery van, or the computers in the office. They're listed first because these are the resources the business uses to generate money in the future. And that's the key phrase right there, future economic value. For something to be an asset, it has to have the potential to benefit the company down the road. Next up, in the 2000s, we have liabilities. This is really the other side of the coin. These are the debts of the business. Essentially, they represent the claims that outsiders, like banks or suppliers, have on the company's assets. This could be a bank loan, an unpaid bill, or even the wages you owe your employees. Put simply, it's what the business owes. You can't understand a company's financial health just by looking at what it owns. You have to know what it owes too. So, what happens when you take everything the company owns and subtract everything it owes? Well, what's left over is equity, the 3000 series. If assets are what the company owns and liabilities are what it owes, equity is the leftover piece. It's the owner's claim on those net assets. This is the accounting equation in action. Assets minus liabilities equals equity. It's the owner's stake, or you can think of it as the book value of the company.
Okay, now we're going to shift gears a little bit. We're moving to the accounts that tell the story of a company's performance over a period of time, like a month or a quarter. These are often called temporary accounts. First up, the 4000 series, revenue. This is the lifeblood of the business, right? It's the money coming in from the company's main operations, selling stuff or providing services. It's often called the top line because it's literally the first line on the income statement. And of course, to make that revenue, a business has to spend money. Those are your expenses, the 5000 series accounts. This is everything from salaries and rent to the cost of the actual coffee beans. Expenses represent the value flowing out of the business in order to generate that revenue. And a key concept in accounting, the matching principle, tells us we have to record expenses in the same period as the revenues they helped create. So tracking expenses is absolutely critical for figuring out if you're actually profitable.
Now, let's drill down another level, because this is where the COA gets really powerful. Within that 1000 asset series, we can have subcategories, like 1100 for current assets and 1200 for non-current assets. Current assets are things you expect to turn into cash or use up within a year. They're essential for looking at liquidity. Can the company pay its short-term bills? Think cash, inventory. Non-current assets, on the other hand, are your long-term investments, like buildings and equipment. As a manager, you need to look at both to get the full picture.
Okay, so we've got the theory, we've looked at the structure. Now, let's make this real. This is where accounting stops being just about recording numbers and starts becoming a strategic tool for management. How do you actually use this blueprint to make smart business decisions?
Let's walk through a practical scenario. Imagine the manager of a busy cafe wants to upgrade their equipment. There's a new state-of-the-art espresso machine that costs $3,000. I mean, the benefits seem obvious. Better coffee, faster service, maybe more sales. But is it a smart financial move? How does the manager go from a gut feeling to a decision based on actual data? Well, they turn to the financial blueprint.
So the very first step is to figure out if they can even afford it. The manager goes to the chart of accounts and pulls up account 1100, specifically the cash in bank account. And bam, the COA gives an immediate, precise answer. They have $10,000. So from a cash perspective, the purchase is doable. See how easy that was? Without the COA, that's a whole process of digging through bank statements. With it, the info is right there. But wait, just because you have the cash, that doesn't automatically mean it's a good idea, right? So the next question is the business healthy enough to support this kind of investment? The manager then looks at the 4000 series, specifically account 4100, sales revenue. By looking at the data in that account, they can see a nice, steady trend of $25,000 a month in sales. This confirms that the business is strong and consistent, which makes the investment feel a lot less risky. And just like that, the decision-making process goes from guesswork to a clear, data-driven analysis. The manager can now confidently explain the choice, maybe to the owner. They can say, look, our blueprint shows we have sufficient cash in account 1100. This new machine will record it as a non-current asset in the 1200 series. And our consistent revenue from account 4100 shows we can support it. The COA makes this a clear yes. I recommend we approve the purchase. See how they're using the specific account numbers? That is exactly what data-driven decision-making sounds like.
All right, for our final section, I want to give you what I consider a bit of a masterclass on what can go wrong. A financial blueprint is only as good as the people who build it and use it. And as you go out into the business world, understanding these common pitfalls is just as important as knowing the theory, because these little mistakes can lead to big problems and bad decisions. Okay, here are the mistakes I see all the time. First, miscategorizing. For example, taking that $3,000 espresso machine, which will last for years, and just recording it as a one-time expense. That's a huge error. It understates your assets and overstates your expenses, which makes your profit for that month look way worse than it actually was. Second, inconsistent naming. You can't track your spending on office supplies if one month someone calls it office supplies and the next month someone else calls it stationery. It creates a mess. Third, a flawed structure. Either it's way too complex with a million accounts that nobody understands, or it's way too simple and doesn't give you enough detail. But honestly, the biggest mistake of all is having a perfect system in place and then just ignoring it, making big decisions based on a gut feeling instead of the clear data right in front of you. So let's wrap up our lecture with this final thought. The chart of accounts is way more than just some technical accounting tool. It's really the company's story, just written in the language of numbers. It shows you where the company has been, it gives you a clear picture of where it is today, and it helps you map out where it's going tomorrow. So, the question I want to leave you with is this: what story is your company's blueprint telling? That's all for today. Thank you.